Hello and welcome to the Revealing Forex Trading course. Let me be explicit. On this course you will learn how to trade on the Forex market successfully in a clear and concise way. There is no unnecessary clutter here, only hard facts and proven methods. You don't need to have a PhD or be a mathematician to learn Forex trading. The rules are simple and clear, while their reliability has been proven over time. All examples are in real time, up to date, and appear in today's market situation, not from years ago. It really isn't that hard once you learn what to do and, most importantly, what not to do. Put another way, what to apply and what to forget about. By investing a small sum into pursuing this course, you may also find out the easy way whether or not you are ready for this business. Yes, Forex trading is not hard. That said, there are too many aspiring traders who struggle because they are faced with an abundance of misleading and contradictory information about Forex trading. You can put a lot of effort into doing your research by reading books and information on the internet, only to find out that many of the things you read about are contradictory and confusing. There are several reasons for this, and explaining all of them is beyond the scope of this course. We will concentrate on teaching you how to apply skills and methods required for successful trading. So, let's start. Now, who is this course intended for? All aspiring traders who want to learn the tactics and skills needed for successfully trading currencies. Students interested in learning how currency market works, what moves it, and how to take advantage of those moves. Those who are interested in protecting their assets against adverse exchange rate moves. Meanwhile, as people increasingly realize that they will be responsible for their own pension funds, it is wise to acquire knowledge in this field in order to have more control. First, let's be clear what is meant by Forex. Forex or foreign exchange is simply about exchanging one currency for another one, nothing more and nothing less. When you go to Paris, for example, and try to exchange your US dollars for euros, you are carrying out a Forex transaction without even knowing it. It's that simple. What is a little less straightforward are the motivations behind those exchange transactions. When you, as a tourist in Paris, exchange US dollars for euros, you don't actually care much about the exchange rate because you need euros immediately. That is your motivation, obtaining euros so that you can buy something when in Paris. Well, banks and big traders have a bit different motivation. They exchange one currency against another, just like you did when in Paris. But their motivation is the profit they can generate from the difference in the future exchange rate for a certain currency pair. They buy euros against US dollars, hoping that the euro will gain value against the US dollar in the future. If they prove to be right, they will earn from the rate difference. If they are wrong, they will lose money. Or they can simply exchange one currency for another in order to minimize their credit or currency fluctuation risk. There are also the currency traders that mainly take the form of corporations, which need to pay for goods or buy foreign resources in the future and want to limit currency fluctuation risk. That is, they want to minimize their currency exposure risk. For example, US chipmaker buys material resources in Japan twice a year. In order to protect itself from unfavorable exchange rate moves in the future between the US dollar and the Japanese yen, it buys right to buy Japanese yen at certain future date at the today's exchange rate. The motivation here is not profit, but protection from price fluctuation risk. So far so simple, isn't it? If you want to buy one currency against another in order to profit from exchange rate fluctuations, you can do so almost effortlessly. Now, your only concern is how to be on the winning side, how to anticipate which currency will rise in a currency pair. If you trade, for example, the Euro-US dollar pair, which one will go up in the future? Is it possible to guess which? And if so, how can it be determined? Do you need to guess? This is an important topic which we will start to explore in the coming chapters. One final important remark. Successful trading has more to do with good tactics than being a good trader. Successful trading is mostly about obeying rules and not much more than that. Unlike sport or a warfare, there are no heroes and villains in this business. Just those who obey the rules and those who lose money. The key is to know which rules work and which to avoid. By saying all that, one word of caution. Never ever risk money you cannot afford to lose. Trading with your son's college tuition money, hoping to double the amount, is the worst tactic ever. Trading currencies and stocks are by default considered to be risky business, so only invest the money that you are ready to lose without suffering many negative consequences. If you are ready to lose a sum for which your wife will call you crazy, she is probably right.